Wall Street is pricing in a quick return to normal. That could be a serious mistake. If Iran's demands derail the talks, the real story is not just geopolitics. It is the Strait of Hormuz, energy inflation, and a market that still looks far too relaxed. In this video, I'll show you why the talks may fail, what Iran is demanding, and which sectors are most exposed if energy risk stays elevated. It is getting very interesting whether the weekend talks will happen at all. Iran has set preconditions that are extremely hard to meet, while Donald Trump is warning that if the talks do not happen, the war continues. Wall Street may be too optimistic, because markets are essentially pricing in a quick return to normal, an open Strait of Hormuz, and a rapid easing of pressure. That optimism is visible in the tape. The Dow was slightly lower, the S&P 500 was roughly unchanged, the Nasdaq slightly higher, and small caps slightly lower, while major tech names like Amazon, Nvidia, and Broadcom outperformed. After 7 straight up days and a sharp rebound from oversold conditions, sentiment is turning euphoric again, and that looks dangerous relative to the underlying facts. Iran's demands are the first problem. A senior Iranian power broker is said to want 2 things before talks begin. Lebanon must be included in the ceasefire, and frozen Iranian assets must be released. Washington and Israel say Lebanon was never part of the deal, while Tehran insists it was. The asset issue is even harder. These sanctions go back to the aftermath of the 1979 revolution, were tightened again in 2012, and were reinforced under Trump. Several billion dollars remain frozen, largely tied to the Iranian central bank, and Tehran wants that money back. The rhetoric from Iran's side is not encouraging. Hezbollah says Iran will make no concessions to the U.S. and will fight to the last breath. The Revolutionary Guard is warning against any deal that would limit missile capabilities. At the same time, people with good contacts say the Iranian system is not acting as a single unified bloc. It reportedly cannot even agree on who should lead the delegation or what authority that person would actually have. That raises the possibility that Tehran is throwing out demands Washington cannot realistically satisfy on short notice. Trump, meanwhile, is mixing threats with optimism. U.S. military assets continue moving toward the region, and there are reports of a heavy buildup. Some observers believe the negotiations are partly a way for Washington to buy time while reinforcing its position. There are also claims that Iran is using the ceasefire window to move additional military equipment toward the Strait of Hormuz, which makes strategic sense because Hormuz is its main lever. One report says 70 U.S. transport planes landed in the Middle East in the past 24 hours alone. The central point is simple. The Strait of Hormuz may determine who really wins this conflict. Ray Dalio's argument is that if Iran keeps its thumb on Hormuz, it has effectively won. Under international maritime law, the strait is supposed to remain open to shipping and overflight, but Iran never signed the relevant UN convention, and that matters. Even if talks do happen, expectations should stay modest. One Arab media assessment says the real objective is just to extend the ceasefire, not to solve everything. The Obama administration needed roughly 2 years to reach a nuclear deal. By contrast, the current U.S. side is relying on figures like Steve Witkoff and Jared Kushner, both business people rather than seasoned diplomats, and critics argue they could easily be outmaneuvered by Iranian negotiators. Markets are already feeling the energy shock. The latest inflation data came in roughly as expected, on the headline number at 0.9% month over month, while core inflation was a touch lower, which briefly helped stocks. But the energy details were ugly. Fuel oil is up 44% year over year, gasoline 19%, and jet fuel 31% in a single month. Airfares are up 15%. The rent component softened the overall number, but the energy trend is what matters here. Consumers are feeling it immediately. Gasoline prices just posted their biggest increase since 1967. Electricity prices are up 7% over the past 13 months. And Trump's approval on inflation is now worse than Jimmy Carter's and Joe Biden's, despite the promise to bring prices down. The University of Michigan's Consumer Sentiment Index collapsed to 47.6, and one-year inflation expectations jumped from 3.8% to 4.8%, well above the 4.2% expected. A New York Times review of 40,000 Truth Social comments found only 25% saying Trump handled Iran correctly. This is where the gap between market illusion and market reality becomes important. The market story says Hormuz reopens, energy spikes briefly, and the Fed eventually cuts rates. The more realistic story is that physical disruption lasts much longer, energy stays structurally higher, and rate cuts do not come as quickly as investors hope. There are also signs Jerome Powell could remain in place longer than expected because the timetable for any replacement keeps slipping. The hard evidence supports that caution. From February to March, exports were down 82% for Iraq, 75% for Kuwait, 70% for Qatar, 34% for Saudi Arabia, and 26% for the UAE. Only Oman benefited. This is what happens when a major share of regional oil exports cannot pass normally through a narrow choke point. Even if the route reopened today, a return to normal would still take time because physical facilities have been damaged and cannot be rebuilt overnight. That is why the comparison with the 1970s matters. Back then, equity markets were slow to grasp what the oil shock really meant. The same kind of lag may be happening again. In just 3 weeks, European airports could face real trouble sourcing kerosene, and airports in northern Italy have already had to restrict flights. Physical oil markets are far tighter than futures prices suggest. Mitsui expects a repricing of supply chains and lasting inflation pressure, and Kepler says production is down 20.5%, leaving a shortfall of 9 million barrels per month. If talks fail and the war continues, smaller airlines could be pushed toward insolvency, retailers and rate-sensitive stocks would come under pressure, the dollar would likely strengthen, equities would weaken, and gold could even fall initially. The relative winners would be energy producers, oil services, pipelines, defense names, and fertilizer makers. If the opposite happens and the situation improves, small caps would likely move first, then the NASDAQ, then the S&P 500, followed by home builders, retailers, and banks as rate cut hopes revive. There is also a second war market participants are watching. New headlines suggest there may be hope for a ceasefire in Ukraine, but those claims appear overstated. Volodymyr Zelensky's actual point was simply that neither Ukraine nor Russia can sustain the war much longer. Romano Prodi argues the U.S. may eventually push to bring the remaining Nord Stream infrastructure back into use under some form of American control, allowing Europe to resume buying Russian energy. Zelensky is also floating the idea of a new defense alliance with the UK, Turkey, Norway, and other European partners in case the US steps back from NATO. Europe is visibly moving away from Trump. Keir Starmer says the wars associated with Putin and Trump are pushing household costs much higher, and Giorgia Meloni has also started creating more distance. In Asia, the same geopolitical shift is visible in a different form. Taiwan's opposition leadership is being received warmly in Beijing. China has increased the concentration of ships around Taiwan, and countries across Asia are leaning more toward Beijing because China, not the US, may be the only power able to influence Iran in a way that protects Asian energy supplies. That broader China shift also connects to the AI trade. Chip stocks have been rallying, but software stocks are under pressure. The issue is that perhaps half of planned data centers may never be built because of shortages in transformers, switchgear, batteries, and skilled labor. UBS downgraded ServiceNow on the view that software is more vulnerable to AI disruption than previously assumed, and the software sector fell another 2.4%. Trump also publicly praised Palantir for its role in the war, giving the stock a lift, although its strongest technical phase may already be behind it. At the same time, Bank of America continues to argue that commodities could be one of the major long-term winners over the next several years, while companies like Porsche and Mercedes are being hit by weak demand from China. The bottom line is that markets are still priced for a quick political fix, a reopened Hormuz, and a return to lower inflation. The evidence points to something harder: prolonged geopolitical friction, tighter physical energy markets, persistent price pressure, and much slower policy relief than investors currently assume.
Thanks for watching. If you enjoyed this video, please leave a like, subscribe to the channel, and share your thoughts in the comments. Stay informed, stay rational. See you in the next one.